Welcome to ETF Leaders, powered by the New York Stock Exchange. I'm Judy Shaw. Joining me today is Edward Rosenberg. He's the Senior Vice President, Head of ETFs at American Century Investments. Edward, thank you for joining me.
Thank you for having me.
Do you believe semi-transparent active ETFs will be a game changer in the industry, and why?
So I do. It has the potential to be something that the ETF space has never had before. And what that literally is, in a sense, is you're bringing forth mutual fund strategies that felt like they were always reserved for that structure into the ETF format. And so think of strategies where where investment managers put their best foot forward, such as concentrated strategies or their best ideas. They've always been afraid to do that in ETFs because they've always been transparent. So they've stuck to mutual funds, and now they can offer it in a wrapper that it's possible that advisors prefer and want over the mutual fund wrapper, or quite frankly to a different audience of advisors who never had the opportunity to use these investments because they didn't use mutual funds.
What are the differences among the various proposed transparent or non-transparent structures? The NYSE/Natixis model, Presidian?
So let's start with the Presidian active shares model. They're sort of a little more unique because they are the most, we'll call them most non-transparent. They don't show their holdings every day. And when you look at that, what they do instead is there's something called the Verified Intraday Indicative Value, just VIIV. And for those that don't know what that is, that's like an INAV today. But instead of published every 15 seconds, it's published every second. That is the only way that investors know the value of the portfolios. They can't look at the underlyings on a regular basis. Now, if you look at the other structures like NYSE or like Mason and the others, or I'm sorry, not like Mason, T. Rowe Price and the others, what you get is that we can refer to them as proxy baskets. They put forth a portfolio that could be some of the same holdings, could be different holdings, but it's a proxy that's supposed to track the fund very well. And so as those come out, they have a little different behavioral structure potentially, but again, you don't always know what's in them, so you're shielding the securities from the underlying investor so they don't know. Now, as the only firm that's actually public with licensing both the active shares models and the NYSE, we've done due diligence on all of them to really understand how they work, really understand what we think are the benefits to clients, and not in addition, but protect the IP to bring the full benefit and the potential alpha that we can bring forth in those products. But the differences are slight, but in the grand scheme of things, they both do what you're asking, what you really want from a portfolio manager and an investor, which is to hide the holdings every day to some degree to prevent front running or free riding.
What are the advantages to an investor, and will they really replace mutual funds?
So I think they have the opportunity to. Now, they'll never fully replace mutual funds, but I think they have the opportunity to replace in a lot of ways. So let's start off with, one, the structure itself is cheaper to run. Two, the structure is more tax efficient. So what I failed to mention in the previous question is, the best part about ETFs is the tax efficiency and the structure you gain from that, the flexibility. You maintain all that with these. So just because I run the same strategy in an ETF and a mutual fund, my capital gains implications could actually be significantly less in the ETF structure versus the mutual fund. So those benefits may lead investors to go forward. Now, if we think of what Schwab announced earlier this year with fractional shares, so I don't have to buy a whole share anymore. If that shifts through all the different platforms out there, now all of a sudden you've eliminated commissions, so they're all free now. Now you can buy fractionals. Is that the next step to get them into 401ks, where potentially they could start really replacing mutual funds? So I think you see there will be some mutual fund replacement in the near term, but long term, it could really replace mutual funds.
And when do you think they'll launch?
So that's a good question. So the hope is for active shares sometime this quarter. Now, that doesn't mean it will. We have some regulatory documents we still have to get through, but the hope is this quarter. I would expect the other structures, because they were approved later by the SEC, potentially like late second, early third quarter would be the earliest I would expect them in the marketplace.
Great. Thank you, Edward.
Thank you for having me.
And that's ETF Leaders, powered by the New York Stock Exchange.